All right, so this video is going to be a little bit different than my normal videos are. I got this video sent to me by a member of my team, and they just wanted me to do like a react video to it. So let's just jump right into it. This is actually from one of my more favorite creators, Graham Stephan. So kind of, in a way, honored that I get to react to it, but anyone can react. So it is what it is. But let's just jump right into it and see what he has to say.
Recently found that 63% of Americans would be unable to pay for a $500 emergency. And when I first read this, my initial thought was that this is unacceptable and it has to change. After all, the unfortunate reality is that financial education isn't emphasized within the school district, so most people grow up never knowing how to manage their money. Quite a few parents don't know how to teach their children about money.
So this is really interesting. Like what he's saying about most Americans not being able to afford a $500 emergency is 100% true. And I think I forgot the exact statistic, but like the amount of Americans that don't even have $1,000 like in savings is insane, especially like in 2024 with like where inflation is at. Like $1,000 doesn't cover hardly anything. The interesting thing though is he said that like the school districts like don't like require financial education. What's really interesting is on state by state, there's a lot of states that are now passing laws that actually require you to take a financial education class. I know Oregon did. I do believe Florida did as well. It's really funny that Oregon did because Oregon also like passed a law saying that you don't have to pass basic math standards to graduate from high school. So yeah, kind of wild.
Money either because they themselves don't understand it as well. And if that isn't bad enough, talking openly about money is still quite a taboo subject for some reason. Honestly, it's quite a shame because despite what you might think, being able to get rich and stash away a ton of money is a lot simpler than you'd expect. And if you could just learn the basics, it becomes insanely easy to be able to turn 100 into 1,000, into 10,000, into 100,000, into eventually $1 million, especially when one study found that 80% of millionaires come from families at or below middle income level. So as a bit of a solution to this,
Yeah, I believe it's like 90% of millionaires are actually self-made. And what he's referring to, 10,000, 100,000, and then $1 million, he's referring to the compound effect. And we'll see if he talks about it. I'm kind of interested. Rule of 72 states, so you take how much your money is growing by. So let's say you invest $10 and it's growing by 10% a year. So your first year you make $1, the next year you make $1.10, so on and so forth. If you take 72 and divide it by that rate, so 72 divided by 10, that's going to take you 7.2 years for you to double your $10 into $20. And that's just like how compounding works and how you can invest like a really small amount, but like by the time you retire, if you're like doubling your money every 7 years, and let's say you start investing when you're 20 or 30 and you work 30, 40 years towards retirement, your money's going to double 4, 5, 6, 7, 8 times and be a very, very large sum of money.
here's exactly what you need to know, the step-by-step blueprint that every wealthy person follows, how and where you could get the highest risk-adjusted returns, and then finally, where I am putting my own money over the next 10 to 20 years, since I'd like to think I put my money where my mouth is. I think I'm doing this right. Although before we start, as usual, if you appreciate videos like this, all I ask for in return is that you hit the like button and subscribe. Doing that just helps out the channel tremendously, and as a thank you for doing that, I'll do my best to respond to as many of your comments as possible. So thanks so much.
So if you haven't, please subscribe to my channel as well.
And also, big thank you to Surfshark VPN for sponsoring today's video, but more on that later. All right, so in terms of where to start, let's get back to the basics. No matter who you are, what you do, or how much you have invested, everybody I know optimizes for something they're always going to keep, and that would be cash. When it comes to this, the reality is most people have no idea how much money they spend or where they spend it on. All they know is that they have a certain amount of money in their bank account or a certain limit on a credit card, and that's what they could afford. Then when their account gets too low, they cut back on purchases until the next paycheck comes in, and then the cycle repeats itself. But this is not how wealthy people manage their money. So if you would like to optimize for cash, which arguably is the entire foundation of being able to build a lot of wealth, start by tracking your expenses over the next 60 days using a software like Rocket Money, You Need a Budget, Every Dollar, Monarch Money, or even your own Excel spreadsheet, and then log every penny that goes into and out of your account. From there, you could determine if you're spending money on things that don't matter, if you're making short-term impulse purchases, if you're overspending on categories that you could negotiate or get for way cheaper, and then hopefully you could cut back and reduce some of those expenses. From my experience, just by doing this one thing, you should be able to save an extra 10 to 15 15%. Because just like a diet, once you become aware of the details, you could begin optimizing for everything without
Yeah, so I really like what he's saying here. The big thing that, if I were to sum all of this up, he's saying to be proactive about your finances instead of reactive. So if you max out your credit card or spend all of the money in your bank account, you're being reactive because it's like, oh no, I have to like pay off my debt or, go make more money, do more DoorDash, right? Versus he's saying be proactive about it, actually take the time to know where your money's going.
exaggeration, there has never been a better time than now in the last 20 years to make money on your money, since high yield savings accounts are at worst paying you at least 4%. And with a little finessing, you could even earn 5%.
I think not even 5% with a little finessing. We'll see if he talks about it. We use the Chase Capital One high yield savings account. It literally is at like it's like 4.5 or 5% right now. It's insane. If you want an even higher one, Goldman Sachs, they still, I don't think they've closed it down yet. They have a consumer banking brand called Marcus, and they were actually pushing 5% at one point, which is extremely high for just having your money in a bank account.
Or more. Like Ally Bank is currently paying you 4.2%, and they're a completely online bank that does nearly everything you'd ever want them to do for completely free. Or Wealthfront is currently offering 5% on your money, and Robinhood Gold members could get 5% as well. Alternatively, if you have some money that you don't mind sitting on the sidelines for a little longer, you could also look into Treasury money market funds, which are currently paying above 5%, like VUX6 from Vanguard or SWIFT6 from Schwab. Personally, I've taken the approach of keeping about 20% of my overall portfolio in a mixture of high-yield savings accounts, money market funds, and treasuries, where I'm currently getting paid above 5.2%. To me, this is money that I'm saving for the near future, and it's also my sleep-at-night fund, knowing that no matter what happens to my income, the economy, or my investments, I have this to fall back on, and it's earning a pretty decent return in the process. Now, second, once you built up a small cash position, now is the best time to begin paying down high-interest rate debt. Look, the fact is, debt is starting to become a massive problem, and if you don't believe me, take a look at the numbers. The average American now owes more than $22,000. Credit cards, car loans, and personal loans make up almost all of this, and at today's interest rates, if you don't make an active effort to pay it down, you could easily be losing out on thousands or tens of thousands of dollars a year. So here's how I approach debt. If the interest rate on my
Yeah, I wish I had the numbers on this, but he made this video 3 weeks ago. It's how to invest in 2024, the best way to get rich, if you want to reference the video. But I don't think the May data was out. It's really interesting because he was exactly right all the way through April, but I think the May data, like credit card spending, like virtually stopped. It's kind of crazy. And like grocery spending's down. Everyone's like theorizing, like everyone's like out of money, or just became like consciously aware, like, oh shoot, the merry-go-round can't go on. I got to stop putting money on the credit card, so on and so forth. But like that's like the fun little kicks and giggles here in June.
debt is higher than what I'm able to safely generate from my investments, then I pay off the debt no matter what. And if the interest rate is lower, then I pay it off as slowly as possible and I invest the difference instead. Or basically, all you have to do is take a look at the debt you have and ask yourself this question: can I get a risk-free, guaranteed higher return somewhere else? If the answer to that is no, then pay off the debt. Although, if you want to pay the debt down as fast as possible, there's two strategies to go about doing this. The first is called the avalanche method, and mathematically, this is the perfect way to pay down debt. This works by paying down the highest interest rate debt first that's costing you the most money, and then once that's fully paid off, you'll pay down the next highest interest rate, and the next, until eventually it's all paid off. On the other hand, the second method to pay down debt takes on a more psychological approach, and that's what's called the snowball method. This works by paying down the smallest balance first, regardless of the interest rate, and then paying off the next smallest balance, and so on. The reason this works so well is because you'll get the psychological win of being able to pay off debts in their entirety, and by doing that, you'll get the boost to be able to continue long-term and stick with it. Honestly, it doesn't matter which one you pick, both methods work incredibly well, and really at the end of the day, just pick something and stick with it. Although third, arguably the most important part of this entire video, when it comes to investing, especially if you're just starting out, look into starting up a Roth IRA. Although before we go into that, I just want to say, I find it shocking how much time people spend securing their finances, and then they make no effort whatsoever to secure their personal information. And I've read hackers being able to online identity safe, no matter where, by encrypting your online from identifying of your device with a recently traveled to would work as normal.
I don't get paid by VPN. When I get paid by VPN, we'll watch the ads.
Or I guess this also works in reverse. Like, did you know that you could watch the Harry Potter series on Shark's clean web feed? This means there's it. So if you're interested, an extra 4 months free at risk-free to be able to try it out and see what you think. A Roth IRA. This is an account that you can contribute up to $7,000 a year into, and then by the time you're 59 and a half, all of the profit that you make within the account is completely tax-free. Even better, but you're also able to pull out any money you contribute.
What he's not saying is if you're like if you fall into the Henry class or high earner not rich yet, which is basically people who make more than $250,000 a year but have less than $1 million in assets, which is like a very large group of the population because it's really easy to make a lot of money. Like if you work in tech in Silicon Valley, you can make a lot of money, but it goes towards rent or a mortgage or whatever it is, and it's really hard to like invest that where cost of living is so high, even though you make a lot of money. And what he's not saying is a lot of those people, depending on what your actual income is, don't qualify for the Roth IRA, but you can do a backdoor Roth. I would consult with a CPA or an account for it. Typically, CPAs want to send you to financial planners, and financial planners want to send you to accountants. Anyways, it's kind of one of those back and forth deals.
Contribute to the account at any time and without any penalty. So essentially, if you make under $161,000
He's saying it.
a year as a single person, this is the pinnacle to building wealth as efficiently as possible. As an example of this, for the sake of simplicity, let's just assume you ignore the rest of the video and all you do is just max out your Roth IRA each and every year to the tune of $7,000. If you start doing this at the age of 20 and you retire at the age of 65 while earning an average return of 8% in the stock market, which is something that we'll cover very shortly, you're going to have $3,145,000 invested while owing absolutely nothing to the IRS. Not to mention, the ideal time to start and contribute to one of these accounts is when you're young and not earning a lot of money, since one, you're probably already in a low tax bracket, so you have more after-tax income left over to invest with, and two, you have decades to let compound interest grow your money into something significant. Separate from that though, in terms of where to open a Roth IRA, practically every brokerage offers one at this point. They take anywhere between 10 to 20 minutes to set up, and it's largely up to personal preference. And that of course brings me to the next part of the video that could either make or break your entire investing career, and that would be choosing your investments.
We gave ourselves 1 year to get this dialed in from idea to
Even though it's relatively simple, the truth is very few people have the discipline to actually follow it without getting caught up in the premise of get rich quick. So if you want the blueprint to building wealth long term, for most people, this is how you're going to do it. First, diversify. This means that you should never invest all of your money into one stock, into one cryptocurrency, into one place, because if you do, there's a chance that you could lose a significant amount of money. For example, tech stocks lost 78% during the dot-com bubble. Housing prices declined more than 50 to 70% depending on the area, and cryptocurrency fell as much as 99% depending on the project. Point being, you have to spread out your money throughout different companies, asset classes, and sectors so that if something happens to one of them, you have something else to fall back on. Second, don't
Not to go like too off board here. I kind of did the opposite of what he said. I mean, I do invest in a lot of mutual funds and index funds. Actually, I typically don't do mutual, I do index. Index have a lower expense ratio, which is how much you pay those people to manage the funds, aka the people who buy and sell the stocks. So like if you take the S&P 500, the top largest 500 companies in the US, those holdings change. Not all of the companies stay as the largest, top 500 companies. Different companies change all the time. Like Lululemon last year became a member of the Fortune 500 companies, and I forgot some weird company got booted. It was like more of an industrial based company when that happened. But like there's a constant change, so you pay a manager to go through and readjust those sales. And like if you buy a like VOO or the Vanguard S&P 500 index fund, the ticker's VOO on it, they have a 0.03% expense ratio, which is very cheap. One of the things that makes a huge difference when you're investing is not uh, not spending too much money on things like expense ratio. A lot of mutual funds, you can get like 0.5% all the way up to 1%, especially if you go with something like with like the ARK fund that Kathy Woods. Uh, and on top of that, if you also have a financial planner, they usually take 1%, 1.5%. They usually call them points, not percents, and that just adds on to it. It just takes away from your gains. and how long it takes for you to double your money, and that all of that compounding. And like you might be like, oh, it's 1%, it's not a big deal, but it becomes significant over time.
Try to beat the market. Even though it's tempting to want to utilize alternative investments, pick your own stocks, and try to get higher returns in your portfolio, the reality is almost everybody fails. Like, even the best hedge funds and investors can't beat the market consistently with every resource at their disposal. So
Yeah, so I made a really big bet last year. I invested a bunch in individual stocks, especially when we kind of had that mild recession coming out of 21, 22-ish. And I saw a lot of stocks that I thought were extremely on sale, such as Amazon. There was Nvidia after Biden banned AI chip sales or graphic card chip sales to China. Um, there was Adobe. There was Shopify. There were several stocks that I believe were trading far below what fair market value was for them. Made a huge bet. It actually paid off. I don't recommend doing this unless you really know what you're doing. At the time, I believed I knew what I was doing, and I figured it was a 5-year play and that those stocks were going to be worth more 5 years from now than they were when I bought them. I'm currently up on every single one of those stocks, and my average portfolio return last year was around 89%, while the S&P did, I think, 35. So, not to toot my own horn, but I did really well. It was an extreme amount of risk, but because of my age and what I was willing to put on the line and what I believed I knew, and why I say what I believed I knew is just simply because you never know. I'm saying what I thought in the moment was the best option, so that's what I did.
So, unless you work for Congress, I wouldn't even try. Instead, you should try to ride the market in its entirety. And sometimes the most simple approach is also the most effective. Like, third, stick with index funds. A few years ago, Warren Buffett famously said that this is the single best investment for the vast majority of people. And I don't think he's wrong. Index funds offer a wide variety of stocks and industries, they're incredibly diversified, and best of all, they're very cheap to own. For example, Fidelity offers no-fee index funds that cover just about anything that you'd want to buy, and this is also how I'm investing my own money. Even though it sounds boring, most of my stock market portfolio is comprised of just two funds, 80% S&P 500 and 20% international. That's it. It's nothing fancy, but it's stable for what it is, and it covers the entire world. And finally, fourth, assuming you do the above, just dollar cost average and do nothing for a very long time. Unfortunately, I would venture to say that for most people, this is the most difficult part to follow, because even if you get everything else right, if you panic sell at the bottom and you don't keep buying when the market drops, you could potentially miss out on some record profits when the market eventually does recover, and that could set you back a lot. Like, just imagine you panic sold in March of 2020 because you believed the market would fall further and you could buy it back cheaper. You would still be waiting. Or imagine you sold at the peak because stocks are really expensive, and then the market just kept going higher. The fact is, practically every study out there has shown that a buy and hold approach over a well-diversified portfolio long-term wins in the vast majority of situations. Although, in terms of how much you could expect to earn from something like this, here's where things take a bit of a turn. Over the last 100 years, the S&P 500 has averaged an annual return of 10.6% with dividends reinvested, and over the last 14 years, that
Here's what actually has me worried. As of like 4 years ago, like pre 2020 and like the 2020 post 2020 boom cycle, the S&P 500 was averaging as like 8.6% over the last 100 years, and the S&P has been so on fire the last 3 to 4 years that it has literally swayed it up like 1.5% or 1.4% to be that annualized return of like 10% over. And the one he's showing here shows 11.48%. It's literally insane. Most people, when they talk about S&P 500 returns, they just assume 8%. So this is what actually, if we're talking about the current market situation, this is what actually has me worried, is that it's swayed 100-year average 1.5, 2 points.
amount is 13.4%. Although the bad news is that that doesn't mean you're guaranteed to see those same type of returns in the future. Unfortunately, your overall average return really just depends on two things. One, when you start investing, and two, how long you invest. For example, the S&P 500 averaged a negative 5.2% return from March of 2000 through March of 2009, which coincided with the peak of the dot-com bubble and the bottom of the Great Recession. But if you started investing in 1978 and continued until the year 2000, you would have seen a 17.4% average return. This suggests that even though we could look back historically and see that 20-year rolling returns have always been positive, annual returns could range anywhere from 2% in the worst case to 18% in the best case. And it's completely possible that future 20-year returns could look entirely different. All of this brings me to a really interesting study that asks the question, with stocks trading at the levels they currently are, what would it take for us to see a repeat of the last decade's performance? Or basically, how likely are we to see another decade of 12.8% annualized returns that so many people have grown accustomed to? Well,
I'm actually super excited to hear what he has to say about this. This is, oh yeah.
answer this, the author makes the point that these last 10 years have been exceptionally good for investors, coming in well above the 90th percentile of rolling 10-year performance since January of 1950. He summarized that much of this has to do with the fact that the Federal Reserve has kept interest rates at such low levels that it forced investors to place their money into the markets if they wanted any meaningful return whatsoever. This also coincided with strong earnings growth, which led to record stock market profits. However, now that interest rates are hovering near their highest level in decades, this author makes the argument that the price-to-earnings ratio would have to double from its current value in order for the stock market to post a repeat performance, nearly 40% higher than the tech bubble peak. Although, of course, there's also earnings growth to consider, because over the last 30 years, companies have benefited from declining interest rates and lower taxes. But to have another decade of record performance would have to include 6% real earnings growth, which is roughly the best ever outcome over a 10-year period during normal non-recessionary times. Or, I guess simply put, don't expect that these types of returns will continue indefinitely. That's why, in terms of what we could realistically see, Vanguard went on record to say that they've downgraded our US equity return expectations to an annualized 4.2 to 6.2% over the next 10 years. Charles Schwab also tends to agree with this, having updated their prediction that US large company stocks will increase by an annualized rate of just 6.2% over the following decade. I say all of this just to set the expectation that earning 12 to 15% a year in the stock market is not normal. It's very difficult to sustain, and it's not something that you should keep in mind if you want to invest long term. Instead, we should set the expectation that long-term averages are something to consider, and over the next 20 to 40 years, it's looking more and more likely that we could see the average 7 to 8% returns, which have been more consistent throughout history. Although in terms of how I'm investing,
Yeah, I mean that's just what I was talking about earlier with like when people talk about S&P, you typically assume 8%. The interesting thing here is he didn't mention AI and how AI is because it's just affecting the market in so many different ways. Technology tends to be deflationary, so like the price of goods and services will come down with the advent of technology because the average worker productivity goes up. It just means there's more abundant, uh, products and services for that. The interesting thing here is again, AI is going to massively increase productivity. I think we could potentially see a 2 to 3x productivity increase per worker. Um, and it's just really hard to tell where the markets could go with that. It's also interesting that those studies didn't talk about. I mean, they were solely concerned about the monetary environment that the Fed created over the last 10 years to 20 years versus, and what was really not stated, like the rise of technology and how that productivity led to like immense increases of like productivity per worker. The interesting thing though too that doesn't really matter is like if you're looking at that 34x like price to earnings ratio, again it's really hard to say because like even though worker productivity could increase, it doesn't necessarily mean that's going to be translated like into that PE. So
my own money, given everything we've just discussed, here's my entire strategy, and hopefully you find this type of transparency helpful. So here's my entire portfolio breakdown. As you're about to see, I've taken the approach of stability and diversity because honestly, I really dislike losing money. I don't know, for whatever reason, it just stresses me out when I see my investments decline in value, even if it's short term. I also tend to price in the worst case scenario possible and then back model based on that. So everything is really optimized for safety and consistency. I guess in
you said back model. Another common term for that is actually back testing. And there's a lot of different sites you can actually go out there and you can put the ticker of the stock or index fund or mutual fund that you're investing in and look at the past 5, 10, 15, 30 year performance and just see how it would have performed. Now, past performance does not indicate future performance, but it can give you a good idea. And when you're looking at stocks, past performance does not indicate anything about future performance, at least in my opinion. If you're looking at index funds or mutual funds, like if you're looking at the S&P 500 and you're back testing that, it's because that fund is being repositioned constantly with whatever the top 500 companies are. So you're getting like the cream of the crop as far as like what the best that like America has to offer is. And there's other funds that's like Vanguard has a growth fund that is a phenomenal fund that I think over the last 10 years has averaged 24% annualized return. And like you can back test that, but like they're constantly readjusting their holdings based off of their criteria. So depending on like the index fund or mutual fund, and you can get into all kinds of different types of funds and investing in like uh, what they do to change their holdings and what their requirements are. But like that makes a lot more sense because they're basing it off of certain requirements and you're getting the bonuses of multiple industries or certain industries over a long period of time.
This is kind of why 35% of my portfolio is held in residential real estate. These consist of properties that I purchased between 2011 and 2020 throughout Southern California, and most of them were fixer-uppers that I renovated and later rented out for a profit. All of them have long-term tenants, all have mortgages that are fixed for 30 years between an interest rate of 2.8 to 3.3%, and overall it's been incredibly stable. On top of that,
The really interesting thing that he talked about there is when you get a fixed rate mortgage over 30 years, you're kind of like locking in your expenses. And as time goes on, theoretically, rents are only going to increase. Now, this doesn't account for deflationary markets, and that could come from a number of different things. You could also actually witness, theoretically, and hopefully, you witness appreciation in your property, but also, like, theoretically, if there's less demand in your market, you could actually see your property depreciate. The other really, and we'll see if he talks about this, but the really powerful thing about real estate, especially if you own a business, so all of, you entrepreneurs out there, you should be looking to invest in real estate, is because of the tax depreciation and how you can offset your taxes by depreciating your real estate.
value
The world needs ways to reduce carbon emissions.
ExxonMobil can help. We're working on solutions for our business.
That can also help businesses like yours.
Heavy industry with low emissions. Let's deliver.
values of these properties have gone up significantly. I have no difficulty renting a vacancy usually within about a week, and the repairs have been somewhat minimal for what it is. The second, another 35% is held throughout index funds. Like I mentioned earlier, practically all of my portfolio is simply two funds, 80% S&P 500 and 20% international stocks, and that's really it. All I do is buy and hold on a regular basis, regardless of where the price is. I don't intend on touching this money for another 20 to 30 years, and honestly, it's just a really set it and forget it approach. A third, like I mentioned earlier, another 20% of my portfolio is held throughout treasuries, high yield savings accounts, and money market funds that are earning about 5.2 to 5.3%. Even though in hindsight, this should have been invested in the markets because the markets have done incredibly well, I like having cash on hand to cover business operating expenses, overhead, living expenses, real estate renovations, repairs, or anything else that just might come up. Plus, earning 5.2% on my money is still pretty good. And finally, fourth, the remaining 10% is comprised mostly of alternative investments, a small amount of Bitcoin, and other assets that are really going in the bucket of, if they go up in value, that's great. And if they decline or are worth nothing whatsoever, that's totally fine too. This is really just the fun category, like the Ford GT, where there's really no expectation whatsoever. So really, as you can see, I've done my best to invest my money equally throughout as many uncorrelated assets and investments as possible, so that if something happens with one of them, the other should more than make up for it. And if something happens to all of them, I still have cash on hand to be able to buy the dip. That's why if you want to build massive wealth long term, a lot of it really just comes down to the basics, and that is optimizing your income and expenses, paying down high interest rate debt, maximizing your tax advantage retirement accounts, diversifying, and then staying consistent long term. I know it's not as exciting as the idea of being able to make $100,000 a month from dropshipping anywhere in the world from your computer, But it's the truth. And if you could follow this consistently, you're going to be able to build a really strong financial foundation long term. On top of that, all of these strategies are really meant to be as timeless as possible so that you could save this video and come back to it a year from now or even a decade from now. And all of the strategies are going to be just as applicable in the future as they are today. Just like hitting the like button and subscribing if you have not done that already. So with that said, you guys, thank you so much. I really appreciate it. And if you want to leave a comment,
Yeah, just to summarize, investing, it's not sexy. And to be frank, it's not always fun. And what you said about dropshipping is totally true. And that's not even investing, that's just a business. What I will say is sometimes investing in yourself to increase your earning potential is going to get you a lot farther and allow you to invest more. It just depends what that time horizon is. And like you said, you don't have to invest a lot in the beginning to make a lot of money. But if you're like right out of high school or even right out of college, sometimes I really lean towards being able to invest in yourself first and increase your earning potential. And that could, I mean, it could be watching Graham Stephan's videos and learning how to invest or how to be a better real estate agent or how to create secondary income, right? All of that's just going to help you be able to invest more and more money down the line, which moves the balance sheet quite a bit over time.